I now want to ask the folks that have been working behind the scenes on the index, Dr. Runger and Abby, if you'd come to the stage. And this is just a discussion behind the math, because the math matters. And I want to tell you a little bit about the story about how I met Dr. Runger, because it really has a lot of heart and meaning for me. So Abby and I were well-intended, and we were working on the development of linear models for each of the supply chains, and we were working on linear regression, and we were cranking right along. And I met Manny at the conference, and Manny's from Intel, and he's going to talk a little bit later. And he took me to the side and he said, you know, Lora, there's not enough math there, right? You really need to apply better mathematical models, and I want to introduce you to someone that's one of my mentors around math and how to think about this, because when you look at those gnarly patterns of those orbit charts, some of them are pretty ugly, and I really wanted to find a methodology to be able to do that. So I met Dr. Runger first at the Informs conference, and I showed him a lot of the orbit charts, and I said, how could we partner to develop a methodology that could really look at supply chain improvement? And we've been working now for about 4 months, and we're going to continue the work. We're not done. But the point is that Manny took me aside and says, this is how we can make this better. And we're very open to that. We're publishing the math. We want to have the dialogue with you, and that's what we're going to do on stage. Now, Abby and I go back about 2.5 years. Those that read my blog may remember Abby sending me in a blog post that said, would there be opportunity in supply chain management? So 2.5 years later, she's on stage with us for a 2-year research project, and she's with the young professionals for CSCMP as well. So, you know, really an example of a young professional making a difference. So what we're going to do now is I asked a polling question earlier, and we're going to just start this panel with the results of the polling question. This morning I talked about how to unstick the supply chain, we need to really think not about a project-based approach, not about vertical silos, but we've got to really think about complex systems and how we manage the metrics as a complex system. So can you push now the results from the survey this morning? Question was, do you manage the supply chain as a system? What do you think, Abby? Does this result surprise you?
Not really. I think it's hard, and so I understand why 45% are saying that there are constant distractions, but, you know, the intentions are there.
Right, and we see this a lot in the orbit chart. So, you know, no, but we manage the metrics in isolation. That was really kind of surprising, don't you think, Dr. Runger, and some of the work that we've been doing?
Well, it does show in the data, and what Abby mentioned as well. You see a great deal of variability from year to year, from company to company, even within the same industry. So, yeah, the survey is consistent.
Yeah. So let's go through the whole process of how we started this work. And, you know, as we think about it, you know, we started with this definition of the effective frontier. And this actually happened when I was writing the book, Bricks Matter. And Abby said to me, you've really got to help crystallize this whole concept of trade-offs. And you know, Abby, as we put together the data and you built this database, tell us a little bit about that journey.
So we started in February of 2012. It was a very manual process, going to corporate websites, investor relations sections, and really pulling the data and putting that into spreadsheets, ratios like the cash-to-cash cycle, inventory turns, and margin.
And we thought it'd be pretty simple, but it wasn't, right? And so, you know, as we tried to figure out which metrics really mattered, talk a little bit about that journey and the journey for, you know, this research.
Sure. So we took about 50 metrics and categorized those into growth, profitability, strength, and cycle. And then this research is really based on the intersection of inventory turns and operating margin. So you've seen that in a lot of orbit charts already, to try to understand what makes it possible for companies to improve both of those metrics at the same time.
But you know, Abby, I've been in the industry for so many years, and I was so surprised at the results. I mean, it's so counterculture to what most people see, you know, and when we show the results, people are surprised. But tell me a little bit about your journey there.
Absolutely. So I think companies are surprised at how hard it is, and when they get a chance to see the data stretching back 10 or 20 years, they can see the progress is not nearly as linear as they expected.
And not as rosy. And so we did this work, and Dr. Runger, we're going to have a student help us to do a little bit of more work around market capitalization. But, you know, how did you get the market capitalization data, and how did we do this work?
Sure. So this is the work that we did in advance of our event last year, and we were looking to correlate the list of metrics on the left with market capitalization. So that's the number of stocks times the stock price, and trying to understand which metrics had a high correlation to market cap.
You know, and the cycle metrics, the inventory metrics come to the top, and that's where we find the biggest issue and the lack of understanding. So this was the promise, and these are the results. And Dr. Runger, this is where we kind of ask you to come in and help. And what have you learned about the orbit charts and all this data?
Well, we tried to quantify so we could put a number on the variability that we see. And, you know, the idea was to score a compact orbit chart to begin with as more desirable, maybe more consistent. With the wide swings in variability, you know, your measure would, in that case, provide a much different score, like we'd see here for this particular example. So the idea was to score sort of compactness. Some of the other measures were looking towards how things are changing in terms of the operating margin and inventory turns over time. But to start with, we just wanted to see how stable a particular company was.
It's amazing how we have a lot of lack of stability in these orbit charts.
Yeah.
Did that surprise you?
Yeah, it did. You know, they really move quite a bit. Even if you extract recession years as sort of anomalies and look around those recession periods, you still see a lot of variability in the charts. And that's through across the industries.
So now, Abby, we learned as we did these reports, and talk a little bit about how we did these, because these are on SlideShare if people want to go back and look at patterns across the industry.
Sure. So we started looking at industries on their own, specific peer groups, and looking at the metrics that matter. So this is a series of about 18 reports covering a wide variety of industries, using the orbit charts and our constant evolution to really understand what metrics matter and what companies are doing right and wrong to manage them.
So Abby, in working with you on these reports, you know, I've been in supply chain for 30 years. I was shocked at how different the patterns are by industry. And, you know, every time you brought me another one, I'm like, wow, this learning, you know, the consumer electronics industry is like, you know, a wild ride, right? What did you see in the data?
Yeah, I think the patterns are very different. And so if you look at some charts, they're very compact and consistent, and companies haven't gone anywhere for the past 20 years. Other companies have been all over the map, but they ended up right back where they started.
Which is amazing because, you know, if you look at it, one of the things we did was we said, you know, in consolidation of industries, because we've been through a lot of mergers and acquisitions, had people, as they had consolidated, companies greater than 5 billion, were they able to achieve higher rates of operating margin? And we can see consumer electronics stayed about the same, and retail actually went backwards, right? So we didn't get the degree of economy of scale that I expected. Your thoughts here?
Yeah, I think for some industries it's really present, and for others it's not. And it was surprising to see where industries fell. It sort of didn't always happen how we expected it to.
And so if we look at regional preferences with food and beverage, back to Dave's talk around complexity and simplification, it really had an impact there. And so when we look at inventory turns, now I found this very interesting because you would think a bigger company would do better on inventory, but those strong functional silos are definitely an issue. What did you see here in the data?
Yeah, I think some industries and some companies really are stuck on inventory, and others are actually moving backwards. If you look at hospitals or retailers especially, the bigger companies have lower turns than those medium-sized.
So, often it can be a little company that's doing things well. So, you know, what we wanted to do was we wanted to have a way that supply chain leaders could say, how are they doing? Because people are competitive, right? So the supply chain index is about improvement, and Dave Beaker talked about moving up the stack on improvement. But performance is how are you doing overall? And I liken this to weight loss, right? So performance, when I step on the scale, I can see relative weight loss, but if I measure inches or I look at my heart rate monitor, I can see the rate of improvement of my body. And so the supply chain's very similar. And so what we did in the supply chains to admire was we looked at average performance and then we looked at improvement. And talk a little bit about the index, Abby, and how did we develop that?
Sure. So the index is really the next evolution beyond the orbit charts, trying to quantify some of those patterns. And the three components that we have are the balance factor, strength, and resiliency. So balance includes the metrics of return on invested capital and revenue growth. Strength and resiliency are both based on inventory turns and operating margin.
Now, Dr. Runger, we gave you the challenge of how do we measure improvement on balance and strength and compactness on resiliency. How did you pick this methodology?
Well, we tried a number of measures for that compactness, but it's more than one variable, so you're trying to measure variability in more than one variable. There's some standard approaches for that. What we wound up doing was very simple at the end. We just looked at kind of the points, looked at sort of the graphic, and looked at the average distance among all pairs of points in one of the orbit plots. And that's a reasonably effective way to come up with a measure of compactness. For balance and strength, we looked at what the trend was towards, in those cases, the upper right-hand side, where the return on invested capital and the revenue growth were both increasing. So if the points were trending to the upper right hand of the graph, then that was a better performance. And we quantified that. We put a percentage change in each one of those variables towards the right-hand side as a measure for both balance and strength. And it seemed to, relate fairly well to what the graphs sort of indicated.
So we equally weighted balance, strength, and resiliency, and we don't know if this is right? We just said, let's start and let's equally rate the balance, strength, and resiliency. But what we'd like to know is your thoughts, right? Because we're continuing to evolve this methodology. So if you can look at your little tent card and look at the URL to give us feedback of, would you weight each of them equally? Balance being the intersection of return on invested capital and growth, strength being the intersection of operating margin and inventory turns, and resiliency, the compactness of the patterns. And C, you're not sure, you're still thinking about it. This is really heady stuff. Abby, any thoughts here about what you've seen and actually doing the index?
Yeah, we've gotten some feedback that made us question the resiliency metric in particular, and if we were actually rewarding companies for being stuck, for having that tight pattern. So that's one place that I've been thinking about. Does that carry an equal weight that it should with balance and strength?
And we've had some other leaders say, well, do they really have an impact on growth? And, is what we've defined as balance fair because of the functional orientation? And I know, Dr. Runger, you've got some thoughts about what we can do together going forward. Anything you'd like to share there?
Well, we talked a little bit about there's an efficient frontier for the measurements where you'd like to show, certainly in balance and strength, you'd like to show improvement in both of them simultaneously. So trying to capture where you fall on that efficient frontier of both of those measurements simultaneously is desirable. Mm-hmm. And then putting some weights related to that possibly for a score.
We're going to get the answers to how people feel in a few minutes. But the resiliency was the tightness of the pattern. And, Abby, one of the things we found out here is contract manufacturing is not very resilient at all, and it's actually a big risk. And communication equipment has a fairly high issue with risk here. And, it's been interesting to see that play out. What are your thoughts here?
Right, so those high values for resiliency are problematic because they represent large swings on the orbit charts. And so you'll see the companies at the bottom of the table, like Lora mentioned, contract manufacturing, consumer electronics and communication equipment, really have low levels of resiliency.
You know, in digital manufacturing, I think offers some promise here. We've got Mike from Flextronics that's going to come this afternoon, and we're going to ask the question. But now let's start through the company. So this is an example where we've taken performance, which is the averages, and we've also looked at the index, and we've built the report, the supply chains that we admire, where a company actually scores above the average on operating margin, inventory turns, and return on invested capital. And again, we only found 19 out of 200 companies that did this, and also pulled up at least halfway on the supply chain index. And Abby, we've been looking at these for a while. What have you learned about consumer packaged goods that you can share here?
I think it's really hard if you look at these companies. A lot of them are often listed as leaders, and yet no one is leading the pack on both performance and improvement. So you can see, Colgate has really high margin, really high ROIC values, but on the index rankings for 2009 to 2013, they came in 13th. So it's very difficult to maximize both performance and improvement.
And they actually fell because they lost 10 days of inventory to Procter & Gamble. And Procter & Gamble has actually gone backwards. One of the things we kept running this analysis time after time because we thought Procter & Gamble would pull up at the top, and Procter & Gamble's called us a lot to talk about this, but they're not making much improvement right now, and they're out of balance, particularly on operating margin. And Unilever's actually made quite a bit of improvement, so it's interesting, though, to contrast performance and improvement. Do you think, Dr. Runger?
Yeah, it is, the rankings and the weighting and so forth are additional work we really want to work on. We want to pull together how the best way to rate the different variables in the final metric. And I think both graphically and with numbers, I think will be useful.
Because one of the things that we want to do is help supply chain leaders everywhere to be able to see how they do. So you can take the index and you can change the peer group and you can change the time period to look at relative improvements. And, I've learned a lot, Abby, about the peer group and the time frame and, the index. And this is the chemical index. You want to talk a little bit about this?
Yeah, so for the chemical companies, you can see there really isn't economies of scale like you might expect. So in that revenue column, some of the smallest companies are right at the top in terms of their improvement over the past 7 years. And then when you look at the rankings, so balance, strength, and resiliency, again, no company comes out on top for all three metrics. So it's really hard to figure out the right way to go about it.
And so a lot of change, though, when we looked at 2009, 2013. Dow, who had a lot to lose, because often we find people that are kind of stuck when they get with a program will lose pretty quickly, and BASF pulls up the stack. Thoughts here on time frame and how to use the index?
Yeah, initially the research, we looked at 2000 to 2013, and the feedback we got was really that was too long of a time period. And so we narrowed it down to 2006 to 13 and then 9 to 13. But we're still trying to find the sweet spot to figure out how many years we need to look at to tell the story.
So, Abby, in summary, what did you learn here?
I think the patterns are very different by industry. So when we talk about best practices in supply chain, that's very specific to the challenges of the specific industry. And I was also surprised to see that we haven't made more progress. And then I think the third component is really that we need your help and your feedback to really refine the methodology to figure out, do we need to weight the factors equally? What's the right time period to look at? What's the right peer group to consider?
So Dr. Runger, talk a little bit about the work we want to do this coming year and how their input can help us.
Well, we think that there's a lot of interrelationship between those variables that are being measured, and so we'd like to understand, do they have any predictive capability between them? Can we use some of the variables for predicting others to try and maybe reduce the number of variables that are involved, or to help create some of these composites or indexes going forward in maybe a little different manner? But it's certainly a nonlinear system, so you don't see many strong linear relationships between the variables, so it's going to take a little more work to try and understand, where's the reduction of gains and so forth in some of those curves, for example, where's the slope bottoming out or so. And so that's one of the plans. We'd like to come up with additional visualizations. The Orbit chart is one great view of the data. We'd like to come up with a few more along those lines to help us out. And then we'd like to look at that efficient frontier and how we can better weight some of the factors together for an index.
Great. Well, we're going to take some questions now, but can you push back the answer to the question of, do we have the ratings right? Should we rethink how we weight balance, strength, and resiliency? Let's push that back. Does anybody have any questions for either Abby or Dr. Runger about the work we've been doing here? So, Abby, anything that you have in particular for the audience about what you've learned in this and presenting it to other people?
Yeah, I think, we've got a long ways to go in terms of where we can go with this. It's been 2.5 years, but there's a lot of refining that we can do of what we've done. And also I was talking yesterday about, can we figure out leading variables or lagging variables? Like, we can take this much further. But I think this is the beginning of an exciting journey.
So it looks like people want us to weight them differently. I'd love to hear some thoughts about that. So anybody got a mic? Want to share some input? Would love to hear your thoughts. We got a mic right up here. If you can just tell us your name and a little bit about your company.
Sure. Thomas Case, analyst over at Spend Matters. I was a little intrigued here by how you generalize these firms as such. Just to think of someone like GE, for example, right? Now they've sold off what everybody thinks of them as, right? The appliance division. So now they're just focused on power generation, jet engines, that sort of a thing, right? Huge difference. So how can you, and since these public firms often, many of them anyway, at least the firms that I look at, they don't want to break out publicly by product, region, etc. numbers. So how can you assess them? There's just so much going on behind the scenes. How do you approach this?
Okay. Abby, you want to take that?
Yeah, I think that's a really great question. So it is really difficult to figure out the right peer group. A lot of times who we come up with is not who our clients imagine they're competing against. So there's always a constant discussion about that. And we've also done work where we have been able to obtain private divisional data, and then we can do more specific benchmarking, like a GE, a specific division, to understand how they compare. But it is really challenging, and we've gone through a lot of different iterations to try to categorize companies. We started with Morningstar, which is how financial analysts might do it, and we've moved to SIT codes, and now we're working with NACS codes, trying to figure out, where are the lines and how do we best draw those.
But we threw out all the conglomerates for the supply chains we admire for that issue. And when we go into a company and we look at their divisional data, we can never share it because we're under NDA, so it's just our learning. So it is as good as we can get right now, and so we can look at pure plays, and we've got to just learn from the data. Okay, we got a question there.
Yes, Lora, Roger Paulson, University of Wisconsin Supply Chain Consortium. So you speak a lot about the intersection of inventory turns and operating margin.
Yes.
I know you've got some other comparisons that you make, but that's one that you focus on a lot. I'm just curious, how did you, or why did you choose those two as the axes on your thing, as opposed to, in some ways of thinking, boy, if operating margin is high, who really cares what the inventory turns are, kind of thing?
Abby, let's share a little bit about that, because we charted for a year, right? Talk about the selection of those two metrics.
Yeah, I think it was a journey of discovery, like Laura said. So we looked at, we made all kinds of different comparisons, including revenue per employee. We looked at cash-to-cash cycle. One of the problems with cash-to-cash is that it's a composite metric, so it has a lot of different inputs, and it's hard to know what's driving the change in the cash-to-cash cycle. So we settled really on simple metrics that are also very meaningful to supply chain leaders.
And originally we plotted gross margin, and supply chain leaders said, yeah, too much swing in gross margin, not as relevant, operating margin. And then we tried cost of goods sold, and they're like, no, there's not as much standardization in cost of goods sold. So they drove us back to operating margin. We're really open to what it is, but we went through about 2 years of discovery. In fact, it's hard to imagine how many orbit charts poor Abby has charted. She's gotten to be the orbit chart queen. So other questions? Good question. Thank you very much. Yes.
John, do you think that some of the trouble with nailing down metric have to do with the fact that the CEOs are often required to maximize their stock value and the rate of growth in the stock, which doesn't always, depending on the nuances of the industry, have to do with, profit and revenue, while it should, or supply chain performance. Like the example was just given with GE selling off the appliances. That's all about, growing their stock value, which has been stagnant for several years. So do you think that's one of the things that you're struggling to nail down?
Yeah, I think we're on this journey, John, from cost to value. And I think that supply chain as a complex system is not well understood by the executive team. And I think there's a bridge that supply chain professionals have got to cross to be able to have this conversation. And I see a lot of misguided consultants who are out there saying, I'll just whack that inventory, right? And not really understand it as a buffer. So I think we're on a journey of understanding. Well, Abby, any last remarks before we close here?
Yeah, I would just love to get feedback to understand what people think of the methodology. And like Laura said, we're not standing up here sort of lecturing on this as a finished product. It's very much in evolution, and we need your help to make it better and stronger and more valuable for you to use.
Dr. Runger, any last-minute thoughts?
Well, yeah, I would echo the same comment and add it's been a lot of fun. There's a lot of data out there available these days, and so it has some interesting challenges to try and put it together and summarize it in sort of a meaningful way.
Awesome. Well, thank you. Let's give them a hand. It's been a 2-year journey. Thank you very much.